In a falling market, with the right strategy, it's possible to make money. At that moment, I had no investment thesis, no plan at all. I just went along with the game because everyone else was doing it. Hope is not a good investment strategy. So let's talk a little about investing. A lot of people feel that investing is this big bubble that's very difficult to understand how to get started with investing and what the choices and opportunities in investing even are. One thing I've experienced is that when we understand the meaning of the words, we can actually understand the content much better. And an important part of the, let's say, learning process that I went through myself was learning the words of the so-called language of money and understanding the concepts. If we figuratively divide investing into two parts, you have investing, which means you acquire an asset that starts to generate cash flow for you. And then there's an activity called trading. So the idea behind trading is that I buy something cheap and I hope to, let's say, sell it for a higher price. Just with that distinction, we can see that there are two types of investments. There are cash flow investments and there are capital growth investments. Now, at different stages of your journey to financial freedom, you need to focus on either one or the other. And just distinguishing between these two different activities makes the picture, significantly clearer. Here are a few examples. Cash flow transactions could be, for instance, if you acquire a rental property and decide to rent it out. That's cash flow, and that's the reason you acquired the property. Or you could do a real estate deal where you buy an apartment cheaply, renovate it, fix it up, and try to sell it for a higher price. In that case, it's a capital growth transaction. So depending on where you are on your journey right now, you should first decide whether you're currently focusing primarily on capital growth transactions, or if you're already at a stage where you have enough capital. For example, you have your own company or business that brings you an annual profit, and you're consciously looking for cash flow transactions. So just distinguishing between these two different investment strategies makes the picture significantly simpler. Now, most people tend to invest for capital growth, and I think one of the most popular asset classes is still paper assets and stocks, because that's what's talked about most in the media. It's where the most, let's say, tips are shared about which stocks are good, which stocks aren't so good, and it's very easy to get caught up in that, let's say, game. But I would say that the most important thing is still what stage you're at today and what your goal is. If your goal is to build an asset that will start to generate monthly cash flow for you, you should probably be looking for that cash flow game. And if you're at a point today where you want to grow your capital before you get into that cash flow game, then you should definitely focus for some time on those capital growth transactions. Now, to talk a bit more about the stock market, it's a good place for simple examples. So most people buy, for example, a certain stock on the Tallinn Stock Exchange, and their only hope or expectation is that the price of that stock will rise in the future. Now, let's say the average or beginner investor doesn't actually do any kind of very thorough technical analysis. And I can also share my own experience here. Like when I made my first investments in 1997, they were also in stocks. That was a period when the so-called Tallinn Stock Exchange opened, when stocks started to grow quickly. There were different banks, Hansapank, US Bank, Hoiu Pank, whose shares then began to grow rapidly. And in the same way, I made my first investment by buying shares in Hansapank. Now, at that moment, I had no investment thesis, I had no plan whatsoever. I simply went along with that same game because everyone was doing it. Now, looking back, I was fortunate that before the so-called crisis arrived, I still managed to sell those shares and make a small profit from it. But perhaps my own experience characterizes this so-called average investor who doesn't really delve deep into it, who just goes and takes that hot tip or invests in a stock that is currently popular and hopes that its price will rise. Now, that hope is not a good investment strategy. It's about as good as going to a casino today and having to bet on whether the, so to speak, ball will land on red or on black. And with such a strategy, it's very difficult to become a winner in this game. And the second problem is that we are betting on the stock price growing versus someone who invests, for example, in dividend stocks. Their expectation is that the company will pay out dividend income every year. And there are also companies that have a very long history of paying out dividends, who have perhaps paid the same dividend stably for the last 10 years. This gives that cash flow investor a certain confidence that that same, 5 to 8% dividend income is what I actually want most. And I'm not really very interested in whether the stock price rises or falls today, because I want to get that dividend income. It's the same with real estate. Do you go into, so to speak, real estate to, so to speak, flip that apartment, buy it cheap, and then hope to sell it for more? Or do you go to catch that rental income? And these are two completely different games where you need to figure out beforehand which game you want to be in. And it's also certainly true that at different points in time, we have to be in a different game. When we are at the beginning of the journey and maybe have a little less capital, we look for those opportunities to grow that capital. And at some point, when the so-called profit or capital is already large enough, we actually want a more conservative but more certain solution where we maybe don't take as much risk, but we get that expected return that we expect from that rental income or dividend stock. So you could think for a moment today about what stage you are at, whether you should focus on capital growth transactions or you should focus on cash flow transactions. And since in capital growth there is this uncertainty, much more. And as I said before, it's not even really investing, it's trading. So it's definitely worth going deep into that game and getting things straight and not just hoping, because hope is not a good investment strategy. Now, if we look at the world economy in a slightly bigger picture, then actually today there are, so to speak, let's say three biggest economic regions: the United States, China, and the European Union. And these three regions make up over 55% of the entire world economy. So if something happens somewhere, it is related to either China, the United States, or the European Union. Now, if we also want to start hedging risks at some point, and this perhaps concerns cash flow investors in particular. So what cash flow investors do is they want to get a certain return with even less risk. And one thing that is definitely a risk is the geographical focus, meaning that some economic regions may do better at certain times and worse at other times. But let's say the two big forces that drive the world economy today are the United States and China. And now, to hedge that geographical risk, it would be worthwhile at some point to create investments that are both on the Asian side and on the American side to diversify the risk that one market or the other will fall. Of course, if there is a global economic crisis, then in the short term, it may be that they both fall. But since there is such a very strong economic conflict, then it is often the case that one does a little better than the other, or vice versa. And that's one of the reasons why I myself have diversified my investments geographically. And perhaps a good example of this is the same Hong Kong Stock Exchange, where I have also been actively investing for the last 3 years. And at the same time that the S&P 500, i.e. the American index, has been making so-called historical records, the Hong Kong Stock Exchange, or the Hang Seng Index, has actually fallen over 3 years from 29,000 points to 19,000 points, which is minus 35%. Now, even if this, so to speak, broad-based market falls or rises, it doesn't mean that you don't have the opportunity to make money from that market. And what we did here with our co-investors 3 years ago was that we started to consciously invest in dividend stocks on the Asian market. And the portfolio that we put together brings us an average of about 7 to 8% annual dividend income. Now, the fact that these stock prices have fallen in the meantime is not our main goal, because we are not in the capital growth game. Since we are in this cash flow game, we are actually very happy that we are getting 7 to 8% versus maybe on the US market, where large companies today pay 2 to 3% dividend income. So even in a falling market, with the right strategy, it's possible to make money, and these last 3 years have actually been excellent. We've actually grown there by an average of 20% a year, along with the, so to speak, increase in share prices. So you could definitely consider that the Tallinn Stock Exchange is certainly a good place to start, but the, so to speak, global economy is much larger. And since nowadays the steps to invest in any country have been made so simple, you don't have to stay in this Baltic game. You can also be in the European game in a broader sense. You can be in the US game and the China game, and thus get a piece of the entire global economy and perhaps get a better grasp of that same macroeconomy of what's happening all around us globally.